Good afternoon, everyone. Thank you for joining us. This is our annual Economic Forum hosted by Stonebridge, and I see a lot of familiar faces out there, so thank you for coming in person. And folks that are joining at home, thank you again for your time. We're going to have a really interesting discussion today. We have Dan Laufenberg, our Chief Economist. After that, John Lynn is going to give us an update on the fixed income market and how we're managing portfolios through these really interesting market environments and shifts, particularly in the yield curve on the credit side. Again, my name is Mike Dashner. I'm a PM, portfolio manager with Stonebridge, and I lead the equity team. So up next, we have Dan Laufenberg, once again, our economist. Prior to Stonebridge, he's been here about 14 years. Dan came on right before I did with Stonebridge. So we've been working alongside each other, and I've learned quite a bit from. He started his career with the Federal Reserve of Minneapolis. So he has a lot of experience on the monetary side. And then after that, he spent several years as the chief economist for American Express and Ameriprise. So what's really unique and interesting about Dan's experience is he's been on the government side, and so everything in the news right now is interest rates and what's the Fed going to do. He has intimate and not inside knowledge, but intimate knowledge. Cut that back. No, I'm just kidding. No, he has a lot of great experience around the policy side of things, but also how it impacts financial institutions once he went to the corporate side. Just a wealth of information, and every time he talks, I just try to take it all in. And I appreciate everyone here, and thank you again. After we give you the updates, we're going to have a brief Q&A. Again, folks listening at home, please type your questions in. And everyone that's joined us here in person, we're going to be coming around with a microphone, so just raise your hand, and we're going to do our best to answer questions. But I will quit rambling on, and let's get the show started. Dan Laufenberg, when you have a moment. Thank you.
It's always a pleasure to be here. It's nice to be seen, and at my age, being seen is very important. So thank you for coming. I'm here to give you an economic outlook, challenging to say the least. Right now, I would argue that the economic outlook is probably about as uncertain as it's ever been. We have economic forecasts ranging from a soft landing for the economy, where everything is just fine, just a little slower, to a severe recession sometime, maybe as early as later this year. That's the range. I'm here to tell you that they all have a pretty good case for any of those forecasts. Any of those could certainly happen, probably a higher probability on each of those than ever before. But our forecast, or at least my forecast, I don't want to assign it to anybody else, it's all my fault. My forecast is that we're going to be somewhere in between that. It's not a soft landing, it is going to be a recession. It's probably not going to be a really severe recession, but it's going to be a recession. But the problem is I don't know the timing of that recession. I'm not sure exactly when it's going to start. It may be a while longer than what most people are expecting. Right now, the market seems to be priced for something really wonderful to happen later this year. Well, not so wonderful. That we actually, I think they're really pricing in a soft landing, that inflation is going to be okay, and that the economy is going to end up in a soft landing scenario. If you look at all the different scenarios that are out there, almost in every case, the key factor is what happens to inflation. What is going to happen to inflation? We had this spike in inflation. The Fed got very nervous. They started raising rates. And everybody, as soon as they started raising rates, everyone was suggesting that we're in a recession, because every time the Fed raises rates, we go to a recession. We all know that, right? Very seldom do they actually engineer a soft landing. In fact, I would argue that there has been one time when they came close to a soft landing, and that was in the mid-60s, where they raised rates, and we didn't actually have a recession as a result. But almost in every other case, they raised rates. The other factor that seems to be out there suggesting that we're going to have a recession is what is referred to as an inverted yield curve. You've got a yield curve where short-term interest rates are a lot higher than long-term interest rates. There's no premium being paid to people that want to invest longer term. Everything is short. So it's inverted. And when that yield curve inverts, typically at some point, we never know exactly when, you're going to have a recession. The lag between the time the curve inverts and the recession tends to be roughly anywhere from 6 months to 3 years. There is my uncertainty about the timing of this particular event. So, we think there is going to be a recession, but I don't know exactly when. I think inflation is probably going to stay higher longer than what the market is now suggesting. I think you're going to see a very sticky inflation rate. Now, you're going to say, well, listen, the soft landing people are talking about how inflation has come down, and it has. If you look at the consumer price index, the overall index, and calculate the percent change from a year ago, it went from a very high level in the early last year to about a 5% number more recently. So it went from what? What was it? 8 point something, 8.5 or 8.7% to 5% in the latest number. So we've had this sharp downward move in inflation. 5% inflation. 5%. What's the Fed's target? What do they think inflation? 2%. They want it to be down to 2. We're a long ways from 2. I'm not sure 2 is actually going to be a reasonable target for the Fed to hit anytime soon. I would like to think of this as a sustainable inflation rate. They want to get inflation down to a level that we can live with. Not an inflation rate that's too high, not an inflation rate that's too low, but one that we're comfortable living with. A livable inflation rate. You know, what is that? The Fed thinks it's 2. It could be 3. It doesn't necessarily have to be 2, but it has to be something that's not so high that you're going to get more inflation as a result of it, and not too low that you're actually going to get deflation, where prices actually start to decline, because you don't want that either. That's a very difficult situation for any central bank or for any economy to be in. So you want inflation to be at that livable rate, a rate that we can live with. So I think for the Fed to do that, if inflation stays high, that they're going to have to continue to keep rates higher longer than most people think, which is why I think we're probably heading for a recession. I just don't know exactly when. Okay? Inflation. What's going to happen to inflation? Well, we already have some numbers, so we can tell you what's going to happen to inflation in some regard. For April, for example, we are probably going to see an overall inflation rate of somewhere around 4 to 0.6% for the month, just in 1 month, 4 to 0.6%. What was inflation last year in April? It was 1% in the month of April. So if you're doing a year-over-year calculation, you lose the 1%, but you gain the, let's say, 0.5%. So inflation is going to be half of what it was last year. So what's going to happen to the year-over-year inflation number? It's going to go down. So it's already going to go down in April. It's probably going to go down again in May. It's probably going to go down again in June. Because if you look at what happened in last year, you had pretty high numbers in those months. You're not going to have that same high number. You're not going to have that outlier rate of inflation in those months. You're just not going to get it. But you are going to get an inflation rate that's still going to be a little sticky. It's not going to be suggesting an annual rate of inflation of 2%. It's going to be suggesting an annual rate of inflation of something maybe 3.5 to 4%. It's still going to be sticky. The key here, I think, to all these forecasts is what happens to inflation in the second half of the year. Not so much what happens to inflation over the next few months, but what happens in the second half of the year. What happens if inflation stays at 3 to 0.4% or maybe 0.5% every month? What happens to the overall number? Well, now we get to see the year-over-year number start to creep up again. What does the Fed do if the year-over-year number starts to go back up again? Are they going to cut rates? No. They're not going to cut rates. Even if the economy slows further, they're not going to cut rates. All right? Now, what's going to happen to the economy? What's going to happen to the growth rate? Today we got the advanced estimate for real gross domestic product. That's the total value of all goods and services produced within the border of the United States, regardless of who owned the assets. All the goods and services produced within the United States adjusted for inflation. The value adjusted for inflation. Real gross domestic product, real GDP. The number for the first quarter of 2023 was 1.1%. right? The economy grew at a 1.1%. Tomorrow's headline in the business section will say, economy grew 1.1%. Probably disappointing estimates because they thought it was going to be a little better than that. I did too. I thought it was going to be 1.9. Just before the number was released, I thought it was down to 1.5. It was still below what I thought it was going to be, 1.1. The surprise to me was that real consumer spending was up 3.7% at an annual rate. 70% of the economy was growing at a 3.7% rate, but the economy only grew 1.1%. What happened? Well, the one number that you look at in that release that suggests why it was only 1.1% is inventories. Business inventories fell dramatically. They took 2.2 percentage points off of real growth in the first quarter. Inventories are way down. Inventory to sales ratios are almost to a record low. 1.2, 1.3, 1.4%. Excuse me, 1.4 ratio. So they're very low. They usually run around 2, 2.2, 2.5. Very low inventory. By the way, has anybody tried to buy a new car lately? New truck, new SUV? Go to the dealer and see what the inventory is in the lot. Do they have any inventory? Absolutely not. Even going to most stores, now they're granted, during the pandemic there was a lot of building of inventories, and there was businesses that built inventories, but those are gone. Inventories have been taken care of. Any hangover that was out there is gone, and the things that people want are still not available in inventory. They're still not on the floor. They're not there. So it's sort of interesting what's going on. So there's room for the economy to actually grow as a result of inventories being rebuilt. Doesn't last forever, but it gives you a month, or excuse me, a quarter or two of growth just from inventories alone. That's going to help. And in terms of consumer spending is probably going to be okay. Why? Because in the first quarter, real disposable income, this is the income that we have to spend, was up 8% at an annual rate. We only spent 2.7%. That meant that our saving rate went from around 4%, 3.8 or something like that, to 4.8%. Had a sharp jump in savings. We are now savers again. We're saving again. We have the income to save. And what's sort of interesting, you say, oh yeah, but we know where that income came from. It was Social Security benefits. Because everybody got a nice big boost to their Social Security check. 8.7%, right? You got all that new income. In fact, what's sort of interesting is, do you know that 25% of all adults in the United States get a Social Security benefit? Either because they're retired, because they're disabled, or because they're a widow. Those are the three categories. 11% of it goes to disabled, 12% go to widows, the rest goes to retirees, Social Security. So all of those people got an 8.7% raise, right? But if you exclude transfer payments, if you look at what income did, if you exclude those payments, it still grew. Real income, real disposable personal income, excluding transfer payments, grew 1.1%. We still saw some growth in earnings. We still saw some growth in real income that allowed consumers to spend. So consumers are not in a situation where they're under a lot of stress. We don't like higher prices, right? We don't like paying what we have to pay for a new car, or for a house, or for furniture, or whatever, grocery store, eggs. Egg inflation is over. But anyhow, and by the way, I have to step back here and tell you, what is inflation anyhow? Inflation, is it high prices? No, it's the process of getting to high prices. I sort of chuckled when I went and bought a new tie. I bought a new tie just for this occasion. Okay, I hope you like it. I paid more money for this new tie than I did for my first suit. Okay, is that inflation? Well, by itself, it's not. By itself, it's not inflation. But the fact that if I went out and bought a new suit, it would cost me a lot more, that's inflation. Because inflation is widespread. widespread price increases. It's not just one thing. If it's one thing, it's a relative price increase. This isn't relative price, this is inflation. A lot of things are going up. Core inflation, excluding food and energy. It's not just energy, it's just not just food. It's a lot of things that prices are going up. And so that's what inflation is, and that's what we're going to be facing with. We're going to be faced with an inflation rate that's not really a level that we're comfortable with. It's not going to be a level that we really want to live with. And that's what's going to, and the Fed's going to be under pressure to do something about it. And it's going to be difficult for them to do something about it because we have a lot of other stuff going on. And the stuff that's going on really is things like, how about the debt ceiling? What happens when the government can't borrow money anymore? You know, we got all these people receiving all these benefits. What happens if we can't make the payments anymore? And not only that, but listen, interest rates are going up. Interest rates are going up. It's costing the government a lot more to service the debt that they have. Interest payments are going to almost increase 3 times in the next 10 years. The interest on the debt alone is going to take a larger chunk of the revenue available to governments to spend. So which means they can't spend on other things. So you're going to try to eliminate, you're going to try to impose a debt ceiling, cut spending, lower taxes. Oh, heaven forbid. It's not going to happen. That's unsustainable. I don't have a solution to where we're at because where we're at is already spent. It's programs that are, debt is basically money already out the door. You have to basically take care of the debt that you have. What you should do is make sure that any future spending that you do is paid for. When you introduce a bill that has new spending program, also include how you're going to pay for it. What tax are you going to impose? Right? Or what fee are you going to impose? How are you going to pay for it? You just can't borrow money. You have to pay for it out of some kind of revenue flow. So it's got to be a fee, it's got to be taxes. And if we want all these things, we got to pay for them. That's the problem. So now you could say, well, we don't want all these things. Well, I was looking at the debt numbers, or the budget numbers, just before I came over. I just thought I'd better do this in case somebody asked the question. And I was looking at the budget numbers, and it really struck me that if you look at mandatory spending at the federal level versus discretionary spending. Now this mandatory is stuff that if you qualify for it, you get it. Social Security, Medicare, Medicaid, food stamps, mandatory. If you qualify, you get it. So it's money that's going to go out the door, whether, as long as the government has some money to put out the door, right? You're going to get it. Discretionary spending is a relatively small component. Discretionary spending basically is the defense budget and the administration of all these other programs, essentially. It's more than that. But it's discretionary versus mandatory. Mandatory, when you talk about the federal budget, there's no budgeting the mandatory. It's all budgeting the discretionary because you have to go for appropriations. See, I worked at the Federal Reserve Board in Washington, D.C. for 14 years, and everybody talked about the Fed being independent. You know why it was independent? Because the Fed didn't have to go to Congress every year for money. It didn't rely on Congress for appropriations. That's what makes the Fed independent. It's not independent of Congress in terms of its policy. It's not independent of the White House in terms of its policy. It's still the Federal Reserve headquarters operates in Washington, D.C. It's still a government entity. It's still impacted by political pressures. It's still there. But it's independent in the sense that it doesn't have to go to Congress for money. It doesn't have to rely on the White House for money. They get money from the investments that they have. And it's nice that they can print money to get those investments. I always thought about profit sharing when I worked at the Fed. Because they back then they made about $25 or $26 billion a year in profit. Now they make about $95 to $100 billion in profit. And I always wanted a piece of that action. But I was vetoed. I was actually chairman of the Federal Reserve Board. I don't know if even my colleagues knew this, but I was actually chairman of the Federal Reserve. I was chairman of the Employees Committee. I was the closest thing to a union the Federal Reserve Board had. So anyhow, so I really think that the economy is going to hold up here for a while. I don't really see it tanking right away, but I think there is a recession out there. I think the Fed will have to do something to make sure that we have a recession. I think people are going to be a bit surprised by how long the Fed stays with higher rates than what is now being suggested. And one of the things you have to remember, and I want to stress this, recessions are painful because people lose their jobs. Things happen. We lose some of our investments. It's a painful situation to go through if you lose your job. So it's not a light, and you can't talk about it lightly, but the nice thing about recessions is that they only last 11 months on average since World War II. And the last recession only lasted 2 months. Remember that one? 2020? It happened so fast we almost forgot it. We almost missed it. It's like, don't blink. Okay. It's over. But it was very severe. It was awful, but it recovered. And so the next recession is probably not even going to be 11 months. I don't know if it's even going to be that severe in terms of timing. It might be severe in terms of loss, but it's not going to be severe. And I don't think it's even going to be that. I think the unemployment rate in the next recession is going to be a lot lower than it has been in any of the previous two, because we have a shortage of workers. What we'll do first is we won't eliminate jobs, we'll eliminate job openings. No, because we have, what, 10 million job openings? We have 10 million jobs that need somebody to fill them. So what do businesses do first? Well, they'll eliminate those job openings. They'll say, well, we don't need 10 million workers. We only need, maybe don't need anybody. 0. Before we need to have to let somebody go. So, but people will lose jobs. But I would argue that the unemployment rate, instead of being something in the neighborhood of 10% like it was in the Great Recession, or something in the neighborhood of 33% like it was for that, or whatever it wasn't 33, it was 20-something in that little 2-month period, 27% or something like that. It's not that. It's going to be something in the neighborhood of probably maybe 5.5, 6, 6.5. That'll be sort of where we'll be at this recession. So it's not going to be very long. It's not going to be as severe in terms of job loss. It might be severe in terms of output loss because we do have a lot of spending that we probably can't sustain. But I think it'll be reasonably well, and it'll be quick. It's still painful, don't get me wrong, but that's what we have in store for us, I think. Don't ask me when. You know, it's the old adage. Give them a time, give them a number but not a time, give them a time but not a number. I'm giving you a story but not a time. So, all right, with that, I'd like to pass this on to John Lynn, our Director of Fixed Income, and he's going to discuss fixed income market.
Well, thanks a lot, Dan. I think I might be one of those guys that says, tell me when the recession is going to hit. I want to know. But anyways, I thought we'd take a little bit of a different tact today in how we're discussing the fixed income markets, and really take a little bit more time to incorporate, how we use our economic outlook and use that to formulate our strategies, and just really how we think about fixed income markets. And I think first I would start with rates. Obviously over the last year we've seen really aggressive rate hikes from the Federal Reserve. And that's really had an effect of bringing yields up across the board for fixed income assets. And as Dan talked about, we're thinking that interest rates are likely going to stay higher longer. If you look back, though, at the end of last year into the beginning of this year, rates were higher. So, we could test those levels. But from a historical standpoint, if you look back the last decade and a half, even though rates have come back some, we're still at levels that were really unattainable for the last decade and a half. So that's really kind of where we're at right now in our thinking. On the corporate bond side, we're investing in bonds, between 4.75% to 5% on very high quality investment grade bonds, really in the 3 to 10 year range. And I think from our standpoint on the fixed income team, our strategy really is, it continues to be invest in kind of buckets out along that range so that, we're not overloaded in short-term rates and we're not overloaded, kind of maxing out duration in that yield range. So we're still minimizing our duration, which I'll talk a little bit later about. That's to manage our interest rate risk. The second issue that I would talk about would be credit quality. And as Dan was talking about, he sees a recession in the future. It's just a little bit hard to nail down exactly when it might hit. But I think it's very important whenever you are feeling that there's a recession on the horizon, that credit, on the fixed income side, your credit quality really needs to be at the forefront of how you're making your decisions. If you think about a company that might be really highly leveraged or over leveraged and might have very low credit metrics in good times, boy, a recession or slowing economic growth certainly isn't going to do them any favors. So the last several years on the fixed income side, our emphasis really has been on increasing credit quality and really making sure that bond portfolio and everybody's portfolio really provides the stability that bonds were meant to provide. And the last thing I think I would hit on would be volatility. If you look back to 2022, that was an extremely volatile time period for bonds. And when we think about volatility and risk in bonds, we think about duration and interest rate risk, which is really the amount your prices fall as interest rates rise. So I would make an argument that really we saw the most of that interest rate risk in 2022 as interest rates rose significantly. If, as Dan is correct, that interest rates will stay elevated for some time, we could see further smaller incremental increases in yield, but so that interest rate risk and your lower duration is still going to be key and very important going forward. But I think one of the bigger risks to fixed income assets could be that debt ceiling that Dan brought up. I think that as we move forward in the next couple of months, as we all know from history, the government generally doesn't act until the 11th hour. So I think that there's going to be a lot of ebbs and flows as we move through that. But really, that volatility, I think, from the fixed income standpoint is going to give us some opportunities to invest and add some higher yields along the way. So I think I will leave it at that and let Michael Dashner, our head of equities, back up here to give you his thoughts on the equity markets. Thanks.
Thanks, John. Thank you. I'm back. So it's interesting, right? I'm going to talk a little bit about our equity management style. And for the first time in maybe my career, our strategy on the equity side is an awful lot like our strategy on the fixed income side. Usually bonds and stocks are two completely different camps in almost every sense of the word. I'm going to sound a little like a broken record if anyone's read any of my writing over the last couple months, and there's a reason for it. We do like consistency. We do take in new data, and we need to move with the times. But walking back to what I said about the fixed income side, if you were a fly on the wall and you were listening to our equity research team talk right now versus how we were talking in the last several years, you would have thought you entered into a bond meeting, a bond research meeting. If you typically listen to stockbrokers or equity analysts, they start with a story and they start with the income statement. They want to know how much money a company makes, how much can I get from it? Right now, we start with the balance sheet. We want to know the credit quality of the company. We want to know their leverage. Now, why is that? I'm going to walk things back just a little bit to what Dan was saying. We're going to have a recession, but we don't know when. You can say that almost every single point in time in the history of this country. Of course, a recession's on the horizon, but we don't know when. We're probably a little closer now than we were yesterday. But the answer there is not to jump in and out of asset markets, because we have to remember, over the long term, the equity market goes up. 95% of the time, the economy grows. So we want to make sure we understand where we're at in the market cycle, but that doesn't mean we are going in and out of asset classes. I'm an equity guy. I'm always going to be in equity. But that doesn't mean we have to take it in blind faith and buy things that don't make sense. So we look at it like a bond trader would look at it right now, like a bond analyst would look at it right now. If we are nearing the end of this business cycle, maybe. But that doesn't mean we're going to start selling all of our equity. We're going to start picking and choosing what companies we think will last throughout the long-term cycle and participate on further upside. Maybe we have a soft landing. We want to make sure we still have ownership and equity. So we want high-quality companies. And again, I've been saying this phrase quite a bit. If you've listened to me last fall, again, read any of the writings, we focus on high quality, high quality, high quality. What does that mean? Well, we're defining high quality by a strong balance sheet. We want low leverage. We want companies that have a sustainable debt load. Throughout history, when you have an unexpected economic pullback, like Dan said, recessions happen because of shock. Shocks only happen because no one sees them coming. So we don't really know when the next recession is going to come. We don't know what's going to cause it. So if we don't know what's going to cause it, what can we do to prevent travesties in our portfolios? It's limit the number of over-speculated assets we have. Now, in the last decade, a rising tides lifted all boats. If you're in the equity market, everything went up. And after that brief recession that Dan talked about, we saw everyone start to invest in what were called meme stocks, stocks that weren't making any money. Somehow they were going up, and we would get a lot of calls. If you've been a client or familiar with Stonebridge, we do things pretty conservatively, even on the equity side. We're large cap companies, well established. And so when we're fielding calls with all these small companies that are going up gangbusters, 100% a day in some instances, folks are wanting to know why are we ignoring that part of the market? The answer is we weren't ignoring that part of the market. We started to see familiarity of what we saw in 1998, 1999. It really felt like the dot-com era. And again, rather than thinking about it like a credit analyst, they started with the story. Well, this is going to be something. This is going to be great. Well, does it make money? Not right now, but it will eventually. Okay. Well, if a company couldn't get a loan from a small community bank with that story, there's no reason they should be a publicly traded company and we should be throwing money on their equity side. So that was a difficult decision to make when everything was going up. But in the end, it paid off. So we're not quite back there now, okay? We're not seeing speculative stocks go crazy, but we do need to stick to our knitting. We need to stick to analyzing and picking companies inside the S&P 500 or outside. You know, there's great international companies out there as well, but we need to start with the balance sheet. We need to start with a quality story. We have to own companies that make money. That sounds really easy, right? We got to own companies that make money. Because if times get tough, the company still makes money. They have a reasonable debt balance. They are going to weather the storm. And guess what? If we don't have this dramatic recession tomorrow, we're going to still participate on the upside. So it's not as fun. It's not as fun as, you know, a really cool story of an emerging tech company that is going to blow the doors off the car and we're going to make 1,000% this year. It's not as fun. But when you take a look at the folks that have been in through market cycle, out of market cycle, into the next one, they've stayed in relatively conservative companies. And staying in the market for a long time in quality companies, that's how you build true wealth. I think I read a phrase once, no one wants to get rich slow. Right? But that's the only way to amass real wealth. That's the only sustainable way to amass real wealth, and that's what we're here for. So I'm going to get off my soapbox. We're going to have a quick Q&A. I'm going to invite Dan and John Lynn back up here. Again, we're going to be coming around with a microphone, and if you're online, feel free to shoot questions in. And thank you, gentlemen. So, a show of hands if anyone has a question.
It really gets back, and it's for really anybody. It'll probably at least start with Dan, I suspect. on the numbers that came out. One of the things that I read today was, yes, consumer spending was up, but the last month it wasn't so much.
Right.
Tie that in with companies like Samsung, who reported a 95% drop in profits and are basically shuttering a lot of their manufacturing and computer chips, which were short during the last one as far as putting them in cars and other things. There's a dynamic going on there that suggests that we're sliding in a little bit, and that we may be, to me, when I looked at it, it says we may be getting to the recession a little bit quicker from the consumer spending side that happens, that people are pulling back a little bit, layoffs at 3M, various other places closing. So just your thoughts on that.
Absolutely. Thank you. I looked at that number as well, and I saw that if the March number that's reported tomorrow, because that's when the March spending number comes out, it looks like it's going to be down at a level 2.2% at an annual rate below the average for the first quarter. So we're going to end the month on a very low level. So the assumption is that you get some kind of a rebound in the next 3 months, given the income that they have to spend. Given that consumers aren't really stretched at all here, they have an opportunity to spend money and to boost spending again to a level that might come out slightly positive. Again, it's not a gung-ho economy we're talking about. But the one thing that I did mention is that inventories are at a very low level. And so once again, you'll have a quarter in the second quarter where inventories and trade may actually save some of the GDP growth that you have. So that'll actually contribute to GDP growth and offset any weakness that you might have on the consumer side. So you're probably going to get a number that's somewhere around 1% again in the second quarter. That would be my early call right now. Now, is it going to be stronger than that? Possibly. Is it going to be weaker than that? Possibly. That's where the uncertainty is. But if you push me on it, right now I would say it's something close to what we got in the first quarter. And is it going to slow down further this year? Yes, I've been saying all along, if anyone that's been reading my stuff, even if the economy avoids a recession this year, it's going to be slow growth nevertheless. It's going to be very slow because our potential growth rate in the United States is low. We don't have any labor force growth. We aren't very productive like we were before. Productivity isn't increasing, so growth isn't just, the possibility of growth just isn't there. That's enough. I can go on, but I'm not.
This is fascinating, thank you. So it appears that the de-dollarization of some of the world's economy has begun. There's a risk of it getting more severe, especially if OPEC were to shift from their pricing from the US dollar to perhaps the Chinese yuan. If this continues to occur, what is going to be the impact on our economy?
Well, I can talk to that first, and then we'll let the others try to answer, because this isn't a try. The dollar as a reserve currency has been an issue for 50 years. So it's not a new story. And the question that you're really asking is the dollar going to continue to be a reserve currency? Because the reason that Brazil might be interested in getting away from pricing everything in dollars is because maybe they don't have as many dollars as they need to buy the stuff that they want, because most of the trade is done in dollars. Most people will accept dollars. So it may be more of a Brazil problem than it is our problem. If there is a need for more dollars, then that means that the dollar strength will continue. And so that makes the dollar stronger. That means it's cheaper for us to buy goods from overseas. We don't have the inflation, so it actually helps our inflation story initially. What will it do to the dollar eventually? Well, it might mean that the dollar goes down eventually, and it loses some of its value, which then in turn becomes inflationary. But I don't see that happening dramatically. It's been a slow process. There's no reason why the dollar should be the reserve currency of the world anymore, other than, here's my argument I've always made. Why the dollar? Why do countries want to hold the dollar? Well, primarily because we are the largest economy in the world. We have a very strong defense, right? So we can defend that economy. And more importantly, we operate under a rule of law. If you buy something in the United States, you know what you own. You have property rights. If you buy something in China, you don't know exactly what you own because the government's going to have part of it. So, and how long are you going to own it? Because the government may say, it's now mine. Thank you very much. So I would argue that as long as we have a strong economy, not necessarily the number one economy, but I think we'll be the number one economy for a long time, because China is still a long ways away from becoming the number one economy. And by the way, I think China could become the number one economy if they were more like us. But they don't have the tolerance for the kinds of things you need to grow as fast as they need to grow to be like us. If it becomes a choice between politics and economics, Hong Kong proves to me that it's politics that will win. So I don't think they'll be the one. Remember, we used to worry about Japan being the number one economy in the world, and they were going to take over the United States, and they were going to stop buying our government debt, and oh my God, all these bonds are going to be on the market, and the rates are going to go sky high, and inflation's going to be awful, and well, no. And I would argue that we don't have that to fear from China at the moment. Not that it couldn't happen, but it's not at the moment. And I doubt it will happen. I can safely say it's not going to happen in my lifetime, because I'm an old man. But, and I don't think it's going to happen in my children's lifetime, and to tell you the truth, I doubt it will happen even in my grandchildren's lifetime. Because we still have the rule of law. Now, if we lose that, then all bets are off. So we want to make sure that we preserve the rule of law. And sometimes in recent years, I've been concerned about that.
We're going to take a couple questions from our virtual guests too.
We have a question asking, what types of investments are best during an elongated higher interest rate environment, especially if you want to be moderately defensive in your position?
I can take that. It
Go
sounds
ahead.
like kind of a yield question to me. You know, I think that it would be, again, I don't want to, you know, talk too much about duration, because I think sometimes that gets lost on folks because it can be kind of a complicated concept. But, you know, I think that investing in fixed income now makes a lot of sense. And, you know, there are defensive structures like premium coupons, which are higher than what market rate coupons would be. But I think that, you know, one of the most important things that you can do is really always try to keep focused on that duration, which is your interest rate risk, and that's how sensitive that bond's pricing is going to be to interest rate fluctuations. But
I'd like to add to that. Ryan Medhog and I talk about this often. I think it was Warren Buffett that said, inflation's the enemy to equity returns as well. When you take a look at the discounted cash flow and calculating your potential equity return, inflation plays a role. And so if inflation goes up and yields go up, your terminal value of your equity investment goes down. There's only really one way to outrun it. It's to own a company that makes more money and grows faster than the rate of inflation. So unfortunately, the equity market is incredibly efficient, and those get sniffed out real early. But the best ammunition against a high yield environment and a high inflation environment is to own the absolute best securities you can. It's difficult to do. But I like John's strategy, and then every once in a while, these high yield environments will also bring about incredible volatility. And with that volatility, it might give you an opportunity to pick up one of those really good companies at a discounted rate. So you got to be patient, and strike while the iron's hot and when everyone else is scared. And it's really difficult to do, even for institutional investors. But I think those are the only two strategies to really keep up in a high yield environment and an inflationary atmosphere.
Okay, we have another one for you. With the de-dollarization in the world, like in Brazil, will that continue, and what are the economic outlooks on that?
I think we've already addressed that. I'm not going to repeat myself, but I'm still as convinced as I was the first time.
If we have any other questions from the audience, we'll take that.
Question on real estate and how you guys might be playing that in your portfolios. I just happened to talk to a commercial realtor this morning, and he was telling me that he has a company here in the Twin Cities that wants to grow and needs 100,000 square feet of industrial space, and there is none to be had, in his words. And then with the onshoring coming, I think we feel the flow of the onshoring coming from things coming back to the U.S. Just wondering where you guys might see opportunity there and how that might be impacting, what you're doing in your portfolios.
Dan, do you have any insight on commercial real estate?
I do not. Clearly, in a recession, commercial real estate does tend to get hit more so than residential real estate typically. So that's something that I would be careful on. It'd be very selective. As you know, in commercial real estate, location is the key. And so you want to make sure that if you own something, you own it in a area that is suitable for you under any economic condition.
Yeah, and to add what Dan said, I'm far from a real estate expert. That's why I tend to stay out of it. And I'm not going to battle you on your commercial real estate fact you had there. But before COVID, we probably were overbuilt in commercial real estate. We saw a tremendous amount of vacancies in different types. How many of us have gone through a strip mall and half the stores were closed, or a mall and half the stores were no longer there? That was before COVID. And those are retail spaces, right? But in the commercial office space, people are returning to work more. So I think we probably saw the bottom in the vacancy from office space. JP Morgan last week said all managing directors are going to spend 5 days in the office going forward. So I think we probably saw the bottom there, and we will see more come back to the commercial spaces. But will it get back to where we were? Maybe, but it's going to take quite some time. So from an investment area, just those two alone, I'm probably going to try to steer clear from it. And we talk about real estate often on our team, and there are some areas that are very interesting. I think diversification is very, very key there, because you just don't know what's going to happen. And so if it was our bailiwick, I could give you a lot more information. But what I've learned about real estate is I don't know very much.
Typically, in an inflationary environment, though, real estate is one of the options that if the economy is growing and inflation continues to go higher, real estate tends to do reasonably well in terms of price. But again, it goes back to what you own, where you own it, and whether or not it's feasible. Now, that's real estate in general. That's not just industrial. And you're asking about industrial, which I'm guessing is probably harder to find in any city anymore. Where's
Could we be at the start of a bull market, considering the fact that the S&P 500 from its October low is up about 16, 17%? Share your comments, please.
Great question. The answer is yes, we could be. We could be. Now, things are still relatively expensive, but that doesn't mean we're not at the start of a bull market. I would you bring up a great opportunity to talk about this fact, though. Yeah, we're up 16%, but if you're talking about the S&P 500, then returns have been spectacularly narrow. Only a handful of companies are actually up substantially year to date. So everyone, when we're talking about the stock market, we always talk about the S&P 500, and that's an asset-weighted index, right? And so your Apples of the world are going to be 6 to 7% of that index. And then you have some other companies that make up only 17 basis points inside that index. And so as those companies get bigger, they take a lion's share of the positive return and negative return. So year to date, before today, because the market was up another 2% today, the S&P 500 was up about 6.5%. If you take that same index and equal weight it, meaning every single company inside that index is weighted the same, it's flat. It's not up. If you had a perfectly diversified portfolio of S&P 500 stocks, you're flat on the year. And that portfolio was down 12% last year. And so if you talk to folks, we're in a really interesting environment right now because a lot of folks are sure we're going into a recession, but the stock market sure looks like it's doing great. It's up, 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 and people feel better about the stock market right now than they did at year end, when in reality, prices haven't changed outside of about 10 companies. But that's just how, I would say, intoxicating news can get, how intoxicating these large companies can get. That shift, we find it's shifting our actual emotional reaction and our outlook on the economy in these companies. And really, it's just about 10 of them that did it. So, answer is, we very well could be in a new bull market. Or we very well could be going into recession in 1 year. It's really difficult to say. So when we don't know, we have to go back to what I was hammering on earlier. You got to buy quality.
It's sort of interesting. It brings me to a point. Someone asked about mentioned 3M laying people off. I remember when companies laid workers off, the price of the stock went up. I just thought I'd mention that.
Okay, we have a question from our virtual audience. How many more trillion of debt is okay for our U.S. government to pile onto the 32 trillion we already have, and when is the point of no return?
That's a very good question. I don't have a limit on how much we can absorb in terms of additional debt. One of the things you have to remember is the debt never gets paid off. It gets refinanced, which is why we have so much of it. It never gets, if you buy a government obligation, you get your money back when it matures, but the government just turns around and reissues another obligation to replace the one they just paid you for. So it never gets paid off, it just essentially gets refinanced. And so the key here will be how much of our economy is going to be needed to service that debt. And so if it comes to the point where it's costing us more to service the debt than we're generating in tax revenue, we're in trouble. So if you're looking for a limit, that's probably it. When the interest on the debt exceeds the total amount of tax revenue collected. That's a long ways away.
What's the answer to that question now? What's that number right now?
Right now, what is the total budget is roughly around, I'd say, what's it, 6.5, 7 trillion? Okay. So the interest would have to be 6.5. The interest would have to be 6.5, 7 trillion. Now, by what 2033, the debt. The total budget will be 8.5 trillion. If nothing changes, of course we're trying to change it, but nothing changed. 8.5 trillion will be the budget, and interest will be 1.4 trillion.
Did that squeeze?
Yes.
Squeeze?
So, in 10 years, we'll be closer.
We have one about the banks. The U.S. seems to have a lot of stresses and crises in the banking system. Do other countries have better regulations so they do not go through these kinds of episodes where their banks are safe all the time? If yes, are they investable banks?
I could talk on it for a bit. Why don't you go first?
Well, I don't know if I have the answer.
I don't know if I do. No.
Okay. The answer, looking at banks, how many banks does the United States have, commercial banks? What, 4,200, 4,500, something like that? Banks, different banks in the United States. How many banks in Canada? 12? Or less? How many banks in China? Actually, it's more than one, because they have specialty banks. They have a bank for every purpose, and they're all government owned, by the way. Well, not all. They're not all, because international banks can operate there. So you actually have Citibank and JP Morgan and all those people there, usually in large cities. So you have other banks, but they're US banks. So the point I'm trying to make here is that the different banking system and the regulation of the banks differ dramatically from country to country. And I get really maybe it's my former Fed experience, but I get really upset when politicians want the Federal Reserve Bank of San Francisco to explain themselves. Why did they let those banks fail? Right? Because it's the San Francisco Bank that was supposedly the regulator of Silicon Valley Bank and what was the other one? Signature. Yeah, and now the other. But what's going on? Why aren't you out there regulating? Well, they do regulate. They do it. If you're a regulator under our system, what can you do to a bank if they're behaving badly? What do? Well, you can threaten to take away their federal deposit insurance. What would happen to a bank if you took their federal deposit insurance away? Boom. Right? What's the other option? You step in and you take over the bank. So what you try to do is you try to make sure that you let the bank correct itself if they will. But if they don't, then you step in and you take it over. That's what you do. And that's what happened. We as taxpayers don't want our tax dollars being spent on people that aren't operating the bank prudently. So, due diligence.
Yep, and to answer the second part of that question, where are the investment opportunities outside of the U.S.? Well, really the only publicly traded banks outside of the U.S. are going to be your major European banks. And their performance has been abysmal.
Well,
their leverage is incredibly difficult.
Swiss banks.
And take a look at the Swiss banks. We just had another, Credit Suisse no longer exists, one of our largest and oldest institutions. So even outside of the U.S., we have these problems. And it's good we're talking about this, right? Because we found 07, 08, 09 was awful. The banking crisis was difficult. We said, we're never going to let this happen again. And then in March, we had 2 of the 3 largest banking failures in our country's history. Regulation needs to catch up, okay? And you have new regulation after you have one of these events where we go, we didn't test for that. In terms of the stress testing they were doing on banks, they didn't account for a rapid 3-fold increase in deposits with the 10-year suppressed trading on, when was the 10-year trading in 2020, 21, 1.9? So, you had banks, you had one bank in particular taking in record deposits. I think Silicon Valley Bank either doubled or tripled in size in 1 year in an environment where the 10-year was trading at record lows. So now we'll have stress tests that test the duration of the investment portfolio relative to the deposits. So we learned, and we're going to learn, and we're going to go forward. But when everyone thinks about bank failures, you think about on the credit side. You think about their loan book deteriorating. Never once in my life did we ever say, what does the investment portfolio's key rate duration look like relative to the inflows of deposits? That's only the second time I've ever said that phrase in my life.
Well, actually, if people were around for the 60s when we had the disintermediation of the savings and loan industry in the mid-60s, when a lot of the savings and loans were struggling because what they had was they were faced with a situation where interest rates were going up, but they were stuck with the limit to how much they could pay on their deposits. Banks were having that problem, but savings and loans were the ones that were really struggling through this period because they had long-dated mortgages as their asset, and they had these short-dated deposits as their liability, and they couldn't raise the interest, and interest rates are going up, so people were moving the money out of the savings and loan and putting it into institutions that were safer. So disintermediation was going on in the mid-60s. It happened again in the 70s. In the 80s with the money market funds that came introduced, the banks were losing money. So we've been down this road before. And by the way, if you want more regulation, I can give you the regulation that would never allow another bank to ever fail again. No one would want to be that bank, but they would never fail again because they would match their liabilities and their assets perfectly. In fact, here's what I'll do. I'll make the short-dated deposits, make those like money market funds. By the way, the value goes up and down. You're not fixed to $1 anymore. $1 isn't $1. You could be paid less than $1. But you get some interest on that. And anything that the banks have to lend out long is going to be financed with debt issued by the bank. It's going to be a finance company. It's going to be a finance company for its long-dated assets, and it's going to be a money mutual fund for the short-dated assets. How do you like that one? I might own that one.
That's good.
One last question very quickly from virtual attendee. And Michael, it's actually on a topic you and I talked about last week. How different from an allocation standpoint are the Stonebridge portfolios managed using ETFs from the same strategy using individual securities?
Oh, okay. I think how different from an allocation standpoint. Okay, well, that's a great question and a good one to end on, actually. So they're the same and they're different. And the reason why I'm going to say this is from the ground up, outside of the mutual fund that we run, every single portfolio is customized to the investment objectives and risk tolerance to each one of our individual clients. So it doesn't matter if we're using individual securities or if we're using ETFs. If your risk tolerance is 60% equity, 40% fixed income, it's going to be 60% equity, 40% income. And we might be using individual securities in some accounts and ETFs in the other accounts. But when it comes to establishing risk tolerance and asset allocations, we start with the client's objectives, and then we build the customized portfolio from ground up. Yeah, we use some individual stocks where appropriate and ETFs where appropriate, but there's no distinction. I mean, if the client has the same risk tolerance, they shouldn't have varying degrees of asset allocation. There's some nuance in there. But no, we want to use all investment vehicles to achieve the goals of our clients the best we can. And ETFs offer a wonderful way to get cost-effective diversification, particularly in smaller accounts. And with larger accounts, we're able to utilize individual securities more and more, and that's really where it ends. Great question. Okay, well, I think we're going to wrap up. Thank you so much. If there are more questions, we're going to be around for another half hour, 45 minutes. Folks listening online, or even when you go home, if you come up with more questions, please don't hesitate to shoot us a note. Get a hold of your relationship manager or call the front desk and we'll get you situated with someone that can help you out. We'll do our best. Again, thank you so much. This has been a blast. I hope everyone enjoyed themselves as much as I did. We're going to stick around. We're going to have a happy hour here. I think that's everything we can conclude, and thank you so much.